Hi, this is Brandon Bischoff with Canterbury Investment Management bringing you this week's Canterbury Market Update. The week is July the 29th, 2019. So the S&P 500, which measures, large cap stocks in the United States, currently remains in market state 1. It has been in market state 1 for 28 consecutive trading days, which coincidentally, dating back to 1950, there have been 259 market state 1 periods. And on average, those have lasted about 28 trading days. So right now, coincidentally, we are sitting at the average. There's also a wide variation in that. For instance, the longest period in market state 1 was 163 days back in 1995. Now, market state 1 typically occurs after there's already been a run-up in the market, so you're more likely to see more peaks. So on average, you see a peak once every about 7 trading days. In this 28-day period, we've actually seen 9 new peaks in the market. And because you're sitting at a peak, you're also more likely to experience a pullback while in market state 1. So that's something we're going to want to keep an eye on. Canterbury Volatility Index measures CVI 53. This continues to be low and decreasing. We're actually coming further and further approaching extreme low volatility, which is less than CVI 45. And what happens when we enter extreme low volatility periods is it's like volatility is getting compressed, like the squeezing down of a spring, and you might experience, 1 or 2 spikes in volatility. And we saw this back in October of 2018. Volatility got less than 45, and eventually we saw, a couple outlier days back to back. And you can see that, following this, there was actually the trading anomaly in December. And this kind of brings us to our next point. We want to talk about, market randomness and distribution of returns. And so one of the conventional wisdoms we fight in investment management is that markets are random and evenly distributed. And we know this isn't true because of the concept of market states. We know that during bullish periods, daily fluctuations are going to be more stable, whereas during transitional and bearish periods, you're going to experience a wide variety of returns. So the standard deviation of the market daily has been about 1%. So that means you could expect a 3% day, plus or minus 3%, once every 1.5 years according to bell curve math. However, in reality, this occurs, once every 6 months. A 4 standard deviation day, you should only expect once every 62 years, plus or minus 4%. However, this occurs every year, it seems like. Back in December of 2018, we saw a 4%, up day on December the 26th. So markets really aren't random according to a bell curve, and they're not evenly distributed. You wouldn't see a 3% day and then 6 months later see another one, and then 6 months later see the next one. You're more likely to experience this back to back to back, like you would see in a transitional or bear period. And so if we look at a chart of daily fluctuations, within a first standard deviation, so within plus or minus 1%, those are what normally occur during bull markets. You might see a couple beyond that, but usually within a second standard deviation. However, as we enter bearish or transitional periods, you see a wide fluctuation, where you see a third standard deviation day, followed by a third standard deviation day, followed by another third standard deviation day. And so, kind of coming into this rally here, we can see that as volatility has declined, those fluctuations have been more stable. And then in May, they got, up beyond just a second standard deviation day, or beyond plus or minus 2% for a temporary time before the market turned back into a bullish environment again. And so if we look at sector rankings or style rankings right now, we can see that large cap growth and large cap value are currently leading. This continues to be the trend as it has been for most of the year. We know this will not always remain true. Styles come in and out of favor, and eventually, large caps might lag small caps who are trending toward the bottom there. And so bottom line, the market's at a peak right now on declining volatility, which is all good, but as we approach extreme low volatility, we might expect to see an outlier day or two, and maybe a pullback or some sort of minor correction in there. We also know that because of the concept of market states, we have the ability to not predict return, but we can predict risk. We can identify securities that have the right trading characteristics, the bullish ones that can limit the downside, limit those daily fluctuations, and then we can combine those securities to create an efficient portfolio. That way we can control the volatility within our portfolio, control the diversification level. Because Canterbury flies in the face of typical and conventional investment wisdoms. We don't think markets are random. We know markets are not evenly distributed. And then we know that investment wisdom based on subjective risk tolerance will not work in the long run. That's why we need an adaptive portfolio, like the Canterbury portfolio thermostat. to navigate, bull and bear markets, limit those drawdowns, and compound returns for the long run. And that's it for this week's Canterbury Market Update. Thank you and have a great week.